Hi, welcome back. In today's discussion, we're going to take an interesting topic which is related to the picture which you can able to see it in this monitor. On the left hand side, a topic related to credit card, debit cards, companies like Visa, Mastro, RuPay card and other things. Right hand side talks about something which is uncertainty. He is trying to do something, but the result is question mark right now. So yes, the today's topic is all about risk, especially the finance risk. That is what we are going to discuss it today. So as our regular process, before going to the new topic, let us slightly recall the topic which we have discussed in the last session. Last session we saw something about the capital asset pricing model. Shortly we called as a CAPM model. In that model we have seen the concept of risk-free interest rate, market risk, market return, how we can or how much return that we can expect from a particular portfolio, and how to arrive all those things that we have seen in the last classes with the assumptions behind the CAPM model. And today's session, yes, as discussed just before, we're going to start about the concept of risk. First, let us try to understand the concept of risk. Risk is it is something which is unexpected one. We are doing some particular task, but we are not sure about what will be the outcome. Say for example, I wanted to go to destinations in 10 minutes. So I am taking a vehicle, I am driving fast, but I am not sure whether I will reach the destinations on time or not. So that is a part of a risk. For a bank, yes, somebody is looking for a loan, a bank manager is ready to sanction the loan, but the problem here is, will the customer repay the loan payment on time? Not sure about that, but the bank manager is taking risk by giving or lending loan to the particular process. And today's discussion is all about a financial risk. Especially we are going to see about how bank or maybe the financial institutions can able to manage the risk according to the requirement. That is what we are going to see today. First we will see the credit risk. Yes, the word credit risk is nothing but a default. Say for example, I am going to a bank and approach for a loan. Let's say the bank lending me a loan of 10 lakhs and I supposed to pay EMI of 50,000 rupees per month. But what if I am failed to pay the payment? Then I become the defaulter. So that is the concept of credit risk. That particular risk pertains to the bank or bank manager who authorized my loan payment process. So that is a credit risk. We call it as a default risk or defaulter risk. Anything that we can able to say in that way. And following to that, we'll try to see the concept of credit risk and interest rate. Say for example, we'll take the same story or maybe the same case. I go and approach a bank for a loan of 10 lakhs rupees. The banks ask me collateral. Definitely without collateral, normally bank won't lend any kind of loans to the public. It depends, of course, there are certain cases. So the bank asked me the second question, is it a personal loan or a business loan? If it is a business loan, the bank will ask my company profile, company balance sheet, or maybe the last 6 months of trading details, tax return filed status. If bank believes that the last 6 month statement or 3-year statements, 3-year audited GST filed details and all those things, if it is not up to the satisfactory level, what the bank will do? One way, the bank straight away reject my loan, or bank will charge me higher interest rate. Why? Because my credit profile is not up to the satisfactory level of the bank. So the bank can take two choices. One is to decline my proposal for loan or try to charge the higher interest rate. Why? Because the bank try to get the maximum benefit before I become a defaulter. So that is the concept of credit risk and interest rate. If the credit risk is high, obviously the bank will charge the higher interest rate. Right? I have given a small example. BBB is the credit rating given to a company, and again AAA is the credit rating given to another company. Comparing a BBB and AAA, AAA stands first, that is the what do you call it as higher rating company, and triple B is the lower rating company compared to triple A. So whenever a company having a lower rate, which indicates higher risk, so obviously money lending to those companies, triple B companies, will charge a higher interest rate. That is the logic behind this. Similarly, when a company having a higher credit or maybe the higher the ranking, obviously the risk level pertaining to the particular company is a lower one. So it is easy for the bank to lend a loan with a lower interest rate. So this is the relationship between the concept of credit risk and interest rate. And we'll see the different types of risk pertaining to the banking financial institutions. The first type of risk is called as a credit default risk. Just before we saw now, the credit risk is default risk. What if the buyer failed to make a payment? Then that becomes a default risk. But there are certain conditions. See, every month or 10th of every month I used to pay my EMI. But due to certain reason, I could not able to pay this month EMI, but I will pay the next month with the fine or whatever the penalty that the bank charges. So I'm skipping EMI for 1 month, but the next month I'll make my own payment, right, with the penalty of whatever. In that cases, I cannot be called as a defaulter. I'm not a defaulter. I'm skipping my EMI due to my personal reason, but in the next month I'll repay with the older EMI pending penny. So that cases I am not called as a defaulter. But how will you define the defaulter? Bank has a certain rules. If a borrower failed to make a due within 90 days, then that becomes a defaulter. No, in accounting terms, we used to call it as a NPA, non-performing asset, which declined as 180 days. It depends. So bank to bank, the country to country, the NPA and a defaulter has been defined in a different way. So between 90 to 180 days, if a borrower failed to make a repayment or failed to oblige their requirements, then that is called as a defaulter. The risk pertaining to that particular portion is called as a default risk. Second one is concentration risk. The concept of concentration comes only when a borrower takes the huge money as a loan. The borrower borrows the lump sum amount, like a Vijay Mallya case. Somebody have bought 9,000 crore as a loan. Yes Bank case. Then Reddy, Mirav Reddy is also another cases. One particular person or one particular company borrowing a huge money from a bank, it obviously is a risk arises, correct? What if the borrower failed to make a repayment? The bank take a very, very bad situation. So this is what a concentration risk. One particular person or one particular company is taking the lion shares, borrowing a huge amount of money, or one particular sector as well. You can take that as well also. A third one is a country risk. When we talk about a country risk, it is an economical risk. When any country having an economic instability, like what is happening in the Israel-Palestine. So fight war between the people. So obviously the economic instability will happen. What was happening in Sri Lanka 3-4 months back? Economic instability. So that type of risk is called as a country risk. I'll recall it once again. One is a default risk, when the person failed to make a payment of 90 days to 180 days, depends on the company or bank. Then that is called as a default risk. Second is a concentration risk, where one particular person or a company takes the lion's share of huge borrowings. A third one is a country specific risk, we call it as an economical instability. So when you talk about credit risk modeling, when you are preparing a model to identify the quantum of credit risk or a way to mitigate our model credit risk, probably these three factors will influence a lot. First factor is called as a probability of default, shortly we call it as a POD, and loss given default, exposure at default. These three are the important terms when we talk about a credit risk modeling. We'll try to understand this concept with a small example. So this is a small example about a company called as XYZ. The company borrowed 10 lakhs money from a bank. They were paying some amount, but due to some administrative difficulties or company problem, they could not able to make a further payment. The loss given default is expected at 38%. We'll move on to the right side of the problem. The exposure at default, which is exactly equivalent to the money which is lent to the borrower. The whole money is exposed to default. At any time that is possible. So whatever the borrower's requested amount or the sanctioned amount can be considered as exposure at a default. So the 10 lakh as such is considered as a EAD. Second one, probability of default. What probability that the borrower may fail to repay the payment? There is no standard instruction or standing rule to be followed. A company to company it might vary. Let us assume that 100% the borrower might default. If the borrower default, what will be the loss for a company? That is loss given default, which is 38%. So by multiplying all the values EAD, PD and LGD, we get the expected loss of 3,80,000. So that is the payment that the bank can expect to be the loss when a bank lends loan 10 lakhs to XYZ company. So this is the concept, and there is no standing rule. The exposure at default or probability of default, loss given default, there is no standing rule set of numbers to be followed. A company to company it might vary. The company fix these details based on the back-end people's instructions like credit analysts. So those people are the right persons for this particular terminologies to be followed, and of course the RBI is also giving instructions on this well. So how to manage those risks? See, when we talk about managing, we have two broader terms to be discussed. One is the measurement, another one is the mitigation. So measurement, how to measure risk, and on that terms we will talk about personal lending and commercial lending. Lending to individual person is a personal lending. Lending to a company or commercial aspects we call as a commercial lending. For a personal, yes, of course, the CIBIL score is the major one. We'll try to measure the CIBIL score of individual or the individual's income level. The tax return statements, if any, that can be verified or can be measured to understand the credit worthiness of an individual. For a company, yes, of course, the company's financial statements, audited reports, GST filed documents, if any, or company's rating by the external parties. That can also be taken as a measurement terms when we talk about a credit risk. The next one is mitigation. Yes, if you feel that the borrowers might get default, try to reduce your duration. Instead of going for a longer durations, maybe you'll try to reduce the duration, or you can charge the higher interest rate. In that way, maybe you can try to mitigate. So mitigate is the concept to reduce. It is not a zero. We'll try to mitigate, we'll try to manage the risk. So there is a small assessment question for you. Dash refers to the amount of loss that a lender will suffer in case of borrowers defaults on the loan. It has to be filled up. So during our regular classroom delivery, we will try to assess the students the acknowledged level or maybe the understanding level, and based on that we will try to refine our statements accordingly. So we'll quickly summarize the topic that we have discussed so far. We started the sessions with the concept of risk, which is uncertainty. Then followed by we understand the concept of credit risk, that is a financial term. The possibility of the borrowers might fail to repay or fail to commit its commitment. We saw the different types of risk, which is default risk, country risk and concentration risk. These three types of risk that we have seen, and the factors supporting, yes, of course, exposure at default, loss given default and probability of default. The three terms that we have understood the concept with the example of XYZ companies. So the last thing that we have saw is the managing credit risk. We have seen the concept of measurement and mitigation. So for measurement, we saw about the individualistic or the commercial aspects. Individual, yes, we have a income statement, a tax filed report. For a company, we have financial statements, audited report, company ratings. For a mitigation, yes, you can able to cut down the total amounts or durations, or maybe you can charge a higher interest rate so that you could try to reduce the figure. So that's all for the today's discussion. As usual, the reference link for the today's class is also given in the PPT. Make use of it in cases if it is needed. So with that note, I'm closing the discussions for the day. Thank you. Bye bye.